Good morning. Thank you for joining us for this month's edition of Coffee Talk. Thank you very much for making some time for us again. As probably most of you know by now, but for the first timers on the call today, my name is Sean O'Brien, the president of QwickRate. And as always, I am pleased to be joined by Steve Huntington. Steve, as you can see, is our director of analytics, and I'll let Steve go ahead and introduce himself. Steve.
Thanks, Sean. Morning, everybody. Again, thanks for joining us. My name is Steve Huntington. I've been working with Sean here at QwickRate for about a decade or so, specifically to try to bring these types of analytics tools to community bankers in an environment that's interactive and easy and clean to access. My background is I've been working with community banks for my entire career, all types of strategic planning, valuation work, advisory, and planning.
Great. Thank you, Steve. Again, just for those of you who are new to our session, we're going to talk just briefly, since we have a number of first-time attendees, we'll introduce a little bit what the CECLSolver is. Steve will give you an update on our scale tool. It's a secondary solution within our CECLSolver. We're going to talk on a couple of things that issues or scenarios that come up quite a bit with users right now. One is the unfunded commitments tab and how that works in our tool. And the second one is since we have new quarterly numbers, just updating your scenarios for the next quarter. Finally, Steve will touch on some of the enhancements we're making or in the midst of making to our Q factors and also the ACL adjustment for held to maturity securities. And then, as always, we will take your questions. Please submit those through the chat or just raise your hand. We will just monitor those throughout and take them either throughout the presentation or certainly at the end. And hopefully we'll have time for all of those today. So that's kind of the agenda. It's a bit more informal. We hope it engages, encourages your participation. It has in previous months. So we want to thank you all for that. And again, thank you all for showing up here today. So here's again, just a reminder how to participate. You are currently muted. So just hit that Q&A box or the chat button and, and submit those questions. I think, again, I've kind of covered all this. I think our thought here was, again, CECL, has been so much in discussion, seemingly for a decade. We wanted to give our users not only the opportunity to try to learn more, but really have an ongoing forum where you can submit questions and hopefully address any issues or your concerns you're having or experiencing, not only with just CECL in general, but maybe within our tool. And so, again, we felt like that would be information that would be best shared with all of our users, and really have tried to make this not only a monthly informational session, but we continue to see it and we'll see it as just kind of a user group moving forward. So again, very excited that that you are here. Let me just check this. There's a quick question here. Will all banks be required to comply with CECL, or will it be a carve out for small banks on asset size? There is no indication that there'll be a carve out. I think the assumption, and I think more, not even an assumption anymore, the fact is all banks are going to have to comply with CECL. But thank you for submitting that question to get us started. All right, let me go ahead and get rid of that one so we move it along. All right, so Steve, I'm going to turn it over to you and let you just discuss a brief summary of the CECLSolver. Take it away.
Thanks, Sean. So just a couple screenshots here from the way our actual CECLSolver works. Our entire tool lives in the cloud and it's interactive. So when you first log into QwickAnalytics and click on the CECLSolver, the data that comes up will be your data right from the get-go. Because we're utilizing the weighted average remaining maturity methodology pretty heavily in the design of our tool, and we're starting our initial segmentation around what's available in the call reports. So of course, you can add custom loan risk pools if you need to, but starting that segmentation around the call report data allows us to pretty much preload the entire tool with you and your peer group's entire historical experience from the second that you first log in. So when you first log in there, you'll see all of your segments of loans. You'll see your historical loss experience by segment. You'll see the same data for all the banks in your peer group, all summarized together visually as well. It's very important to pick a good custom peer group when you're looking at historical loss data for obvious reasons, geographically specific peer group and like banks specific as well. So our tool makes it very easy to build a custom peer group and apply that to the loss ratios and the Q factor section of the tool. The first step is calculating weighted average remaining maturities. We help you through that part of the process. And once we plug those into the tool, it kind of takes off and running by itself and takes care of the vast majority of the rest of the number crunching for us, right? We calculate lifetime historical loss rates for your bank by loan segment. Then we go outside of your four walls. We do pretty much the entire analysis that we do for you. We do for all the other banks in your peer group simultaneously in the background. So just crunching a ton of that publicly available data so that we can get really good external benchmarks, right? If you haven't had any losses in a particular segment of your portfolio over a long look back period, something probably every one of you on the call is dealing with currently in at least one segment of your portfolio. We still have to establish some sort of reserve for that segment, despite our historical data suggesting maybe very little, if any, might be necessary. That's where we have to go outside and look externally for some cues as to what's happening in the environment around us. So that peer data really comes in very handy in justifying our qualitative factor adjustments. But the way our tool is designed, again, since it's interactive, whenever you change any input or assumption in our tool, the entire model recalculates instantaneously on the fly. It recalculates the CECL reserve required for each segment and then recalculates all the way down to the bottom. So the great thing about that is there's a lot of scenario building and what if analysis when you're projecting anything into the future, which is really what we're doing with CECL, right? We're having to estimate lifetime potential future losses on all of our loans. And so it's a challenging thing certainly to do. And it's very difficult when you have a very complex methodology and you plug in hundreds of inputs and you get one number is really what you're looking for, right? It spits out the CECL reserve. And if you can't figure out why that number is higher or lower than what you expected, or whether it's higher or lower than what it was last month or last quarter, it becomes extremely challenging to figure out what's really changed and what's going on. That's not an issue with our tool because of the way that it reiterates and recalculates everything on the fly as you change assumptions. So we think it's very efficient from a tool management perspective. In addition to your historical data and your peers' historical data, there's a module in the tool for managing individually assessed loans wherever and whenever we need to kind of cull some loans from the herd because they have significant issues in the quality of the credit and we need to individually assess it. We have a more robust tab now to manage your qualitative factor adjustments, both internal and external in nature. We have some great visuals which kind of summarize everything going on with a particular segment from a CECL perspective. So you can see on one chart your historical loss trends, your peers' historical loss trends, your look back period, your required reserve, and maybe even some economic trends overlaid right on top of that. So some really good handy visualizations in the tool as well. Sean, if you can flip to the next slide. And so this is just one more to remind you, once you've built a scenario here using our tool, one click to save that scenario, and then you can come and access it anytime you want to. You can have as many scenarios as you'd like. In fact, we really designed this to be a repository of all your CECL reserve scenarios over time. So you can track how those numbers are changing as we get closer to implementation date. Certainly you'll want to be able to export the tool. You can export the tool anytime you want to into an Excel format, into a PDF format, and you have total control over how much of the tool you export, whether you want just kind of an executive summary for the board this quarter, or whether it's time for an audit or an exam and you want all the nitty gritty in details in the export. You can manage that any way you want to. Do we want to tackle any more of the questions here before?
Yeah, we'll take those now.
Go
So
ahead.
the next question is, do you feel there will be any further extensions to the deadline for compliance with CECL? Can you remind us of what those deadlines are? And is there a requirement on the number of quarters that we need to run parallel calculations? So 3 different questions there. The first one, no, I do not anticipate any further extensions for the deadline for compliance. The deadlines really are, as of December 31st, you will make an evaluation, or typically for year-end filers, make an evaluation of where the reserve is as of 12/31, and then the
January
first quarter,
1st.
January 1st, excuse me.
Yeah, so not
Yes.
the fourth quarter of
Yes.
this year, 12/31, everything will be as it's always been, but
Correct.
starting on January 1st of next year.
Thank you. And then, so then the first quarter of next year, you'll have that first potential provision under the new guideline. There is no requirement on the number of quarters that you need to run parallel. Again, I think the bigger issue here is, it's going to be, while there's many things we'll build upon, it is different. So I think just making sure you have a comfort level with your process, I think gives you, some incentive to do it over more quarters, but there's no requirement. Steve, anything you want to add there?
No, when people ask me about, when should we start doing it in parallel, my response usually is, when's your next exam? Or when's your next audit, right? At some point later this year, somebody is going to be asking you, most likely, to see where you are and what you've done. And at that point in time, you should have already run at least a couple parallel runs, so you're comfortable not only with what your surplus or shortfall might be at the beginning of next year, but also what the process is, how we're documenting the qualitative factor adjustments, which will be a little bit different than we have in the past. All that you should be pretty comfortable with before anyone comes a knocking, so to speak.
Okay, good morning. Next, Bill has a question. Good morning, Bill. Our accounting firm is looking for a matrix that might look like this. Q factor of X equals unemployment rate of X. And as unemployment goes up or down, the Q factor would be adjusted to X. A number / calculation they can audit. Do any users on the call have an example of this, or are they getting questions from the auditor? So I'll just take a quick stab at this, Steve, and then certainly you can offer. And then if any of the participants have a feeling on this, this to me, Bill, is something, again, that we have talked a lot about, feels like precision over accuracy. I think you can go back to March of 2020 when unemployment spiked up during the pandemic, and there was really no change so far, for credit experience for most banks, right? So it feels like this is a rabbit hole that you can go down into that isn't necessarily going to give you any more accuracy, but it does now require a greater level of precision and effort on your part. That's my personal feeling about it. I think there's a number of different ways you could potentially, try to move to more objective things like that. But I think for most banks, this is just an exercise that's just not really fruitful. Steve, your thoughts?
Yeah, I'd agree with that. At this point, we're constantly monitoring what we're hearing from examiners on the ground and from accounting firms as to their expectations for CECL, and those expectations are evolving, right? We shouldn't assume that the typical examiner really understands CECL that much more than we do at this point, but their understanding, learning curve is certainly exponentially increasing at this point. And so I think the further we get into CECL, and as we get into next year, and the examiners are all used to looking at it, they'll be a little bit more specific about what they like to see and what they don't. And we're constantly monitoring that to see what areas we can add and things we can do with our tool to improve it from that standpoint. We're certainly going to be adding some more economic type processes to our tool. We don't have a timeline on that right now, but we're always looking at that and interested in it. If anybody on the call, I think Bill was kind of hinting at that too. If anyone on the call is using that it has a matrix like that, or has a good resource for that, go ahead and use the chat function, because if you type something in the chat, then everyone else can see it. Maybe you can say, hey, Bill, here's my number. Shoot me a message and we can chat about it. So we encourage that type of back and forth here on our informal calls. But thanks, Bill. Good question.
Thank you, Bill. Thanks, Steve. The next question, does this address SBA and FSA guarantees? And so, yes, again, I think this is an area where you can carve out specific pools or create additional pools beyond the call report codes that we have. A number of banks, currently do this with their SBA or FSA or any other type of credit enhanced portfolios to separate those. So the level of granularity that you want to use within this tool is available to you. Steve, anything you want to add there?
Yeah, I don't know if you guys saw me. I'm playing with the technology here. I circled the there's a column there where we plug in our current loan balances. So once we've calculated our expected future loss rates for the for the collective pools, then we apply that to the correct or current and correct balance that we want to apply it to. So this is the area where you can exclude any balances that are outside the scope of CECL. That would include if you have any PPP loans still on the books, sitting in C&I or somewhere, you can exclude those balances and make a note of it right there, so that we're not calculating reserves on balances that it's inappropriate to do so. That would also include SBA, the government guaranteed portion of any SBA loans. We don't need to be establishing reserve on that section, and any loans held for sale at fair market value, right? They're outside the scope of CECL completely. So there are certainly areas, balances we'd want to exclude from the analysis, and it's very easy to do so and make note of where you've done so in the tool.
Yeah, and I think that's, again, I think, to an earlier question about, running parallel, I think these are the types of things that you can figure out and decide how you want to handle going forward. Because again, our position on CECL, right, is we want to get you transitioned. This is going to be a process. And, and as these types of issues come up, you're going to want to be able to just to kind of see how you want to work with those and handle those. And so, the degree of granularity that you want to choose is up to you, and we can incorporate that into our solution. The final question then, will peer comps be for ag be available? So a couple of things on peers. We have within the tool the ability to create, or you have the ability to create as many custom peer groups as you would like. As Steve has probably said on previous calls, ag portfolios, have been handled differently throughout the years for the call report, which makes them hard to give a good, consistent historical presentation of those. But yes, you can certainly create peer groups based on the ag, and you can certainly, to the extent that you have ag lines or other things that you want to carve out from the other pool, you can do that. Steve, again, your thoughts.
Yeah, it's something we've been asked many times in the past, and as Sean was saying, the ag loans are challenging because the powers that be at the FDIC have decided they like to, in trying to make it easier for everyone to file the call reports, they put a bunch of threshold limits on when you have to fill out data with regards to charge-offs and recoveries for ag loans. And sometimes banks will bounce into and out of that threshold over time. And so you don't get a clear, consistent apples to apples picture of how those ag loans on an industry basis or on a peer basis have gone. Despite that, and we're aware of that, we've been trying to get the most accurate calculation we can and have it be something that we can add to the tool. And that's definitely on our list to do so. But there will always be some footnotes saying that, hey, this peer data might not be completely accurate because of threshold limitations and people filing some quarters and not other quarters, if that makes sense.
Great. Thank you, Steve. Let's see. We'll keep moving here. Okay. And just a follow up again, I think our position has been and continues to be that CECL will be a process that will evolve. Again, I think the degree of granularity that you want to choose is up to you. But again, I think it's important to remember to not mistake precision over accuracy, right? And so sometimes, again, we want to be, and I think you want to be, diligent in satisfying the standard but also not creating unnecessary work that's not going to potentially add additional value for you. We can scale with you, but I think that's, again, part of the process that, we're just going to kind of experience over time as we move forward with Cecil. So scale is now out there on our tool. Let me make sure. Oh, we got one more question, Steve. How are banks thinking about the prepayment rate and curtailment rate estimates in light of the rising interest rate environment, which generally leads to lower prepayment curtailments? Similarly, are banks generally recasting those rates each quarter or once a year? So again, a couple of questions. Absolutely, you're right. I mean, the rising rates are going to, impact the prepayment speeds. And so again, I think it kind of highlights, some of the challenges that are just inherent in trying to forecast things, right? So I think as with anything, reasonable assumptions are not to be discounted or discarded because, again, how much time do we want to spend on a prepayment speed? The point of a prepayment speed really is the higher the prepayment speed, the shorter the warm is going to be in our tool, right? So if you don't want to shorten the warm, or if you don't want to be, if you have a higher prepayment speed, in many ways you're being more conservative. So I think there's other questions to ask as to whether to recast them every quarter. I think, again, this is going to be something that's different with every bank, but I think you can certainly review them each quarter. But I think, most banks will probably look to change those maybe, semi-annually or every year, more than likely. Steve, anything you want to add?
Yeah, I think, Sean, I think you meant was the lower the prepayment speed, the more conservative you're being. So what we have an Excel tool that we created to help banks with the warm calculations, because it's not something we can get publicly from the call reports because it's not something they ask you guys for. And so obviously the warm calculations, you're either getting it from your core, or you're calculating it internally, or you're telling us, hey, we don't have anyone who can really, who can do that, or anyone we can task with that. Can you guys do it? And if that's the case, then we can handle the warm calculations completely for you. The prepayment assumption is always going to be an assumption that you have to manage and defend. We typically start with relatively conservative prepayment rates, closer to the 5-10% range, which certainly over the last few years, that would be a very conservative estimate. There isn't a lot of really great industry data on those prepayment speeds out there. We try to get some better guidance from FASB and the FDIC, and they kind of shrugged their shoulders a little bit and said, well, everyone's a unique snowflake and we can't really help with that, which is kind of what we expected to hear, but that's okay. But yeah, we'll definitely see some, slowing of prepayment rates, especially for things like mortgage loans in this type of rising rate environment. For some segments of the portfolio, it doesn't amount to a hill of beans of difference, right? For some of your shorter duration loans, if you've got a bunch of loans out there, construction loans, that are 1-2 year, maturity at most, even if you change the prepayment assumption by a significant amount, it doesn't make very much of a difference in your average remaining life of your loans. And so therefore, it's not going to make a huge difference in your CECL calculation. But it certainly is a big assumption for things like mortgage loans. And how often do we see people recalculating those? We can't really, not a helpful answer, I know, but it's all over the board, right? It's all across the board, and there's no great guidance right now. So what they would tell you is, as often as you think it might reasonably change, which is, again, also not particularly helpful, but we start with quarterly. And then if we see things not changing often, we back off to semi-annually, certainly not more than quarterly, but that's probably where I'd start.
Thanks, Steve. The next question, is there a risk to having a large qualitative factor adjustment? I guess the way I'm interpreting this question is there a risk in having, your reserve, predominantly supported by Q factors? I would say no. I would say the majority of banks we are working with today, that's the issue. It's one of the reasons why we like the portfolio methodologies, utilizing the call report, because what we do know from the regulators is they did not want to see CECL be a reason that banks proactively lowered the reserve, despite the fact that most of us have been experiencing relatively low loss rates for nearly a decade. So it brings into the subjective nature And part of, again, just the practical realities of a reserve methodology is that despite the fact we've tried to make these things more objective, or to the earlier question about, objective differences or matrices changing based on factors, the reality is, as long as you have Q factors which are subjective, you're always going to have a little bit of this game going on. And I think that's just the reality of what it is. And so what you need to do, and what the regulators have consistently said to us, is just let them understand your process. They're not trying to prescribe how you should handle something, but they do want to understand how you are making changes to that. Steve, anything you want to add there?
Yeah, it's a really good question. There's one thing I would remind people of is making no qualitative factor adjustment is also does not give you a pass. Just leaving it at 0 is also that's still an active thing that you're saying. You're saying that I've reviewed my historical experience and I believe that it will be similar moving forward that it has been in the past. So I don't think, having qualitative factor adjustments, even ones that are maybe significant in size, is not really, in my opinion, a red flag. You have to justify whether you have them or if you don't have them. And especially if you've had a recent significant loss in your portfolio. I mean, if you had 9 years of clean, C&I, and then all of a sudden last year you had one large relationship that had been problematic for a long time, finally goes south, you said, listen, we've got to cut and run. We're going to take a significant charge off just this quarter, clean it up, not something we expect to see in the future, and it's really limited to that one relationship, right? That huge charge off is going to play a big role in your historical loss rate. But you might end up having a significant negative Q factor adjustment for that segment. And it's totally justifiable. It's just about documenting what happened with that relationship, why it's something you think is not systemic. And then, you can even add in some other data about your risk profile, your risk migration going in the right direction for all the other relationships in that segment. So no, I don't think it's necessarily a red flag, but just know it'll be more heavily scrutinized. So you'll want more narrative around it, more documentation.
Thanks, Steve. The next question is, do you think it might be helpful to allow for calculations within input fields? For example, we need to reduce the loan population subject to CECL for C&I to account for SBA and PP loans for audit purposes to show why that figure isn't matching up to call report loan total balances. Could we see what the original figure was and the adjustment balances? Or is it just better to make note of those adjustments?
I'll jump in on that.
Yeah.
So right now, the tool only allows you to make to write out the math if you want in the note field, and you're just simply overriding what the current total balance is. There isn't an A minus B equals C, right? Total balance minus any of your adjustments and what the adjustments are, and then the net. That's another column that we're considering adding. We always get lots of really good ideas of things we can add to the tool, but at the same time, we want to balance that with making sure the tool is still manageable and just doesn't turn into a monster, right? And so, but that's one has been mentioned, we've looked at in the past. If we can fit an additional column there on the summary that doesn't kind of make it unmanageable, then that's one of the ones we're looking at adding. But for now, at least you can probably get away with, you make it in the notes field. If you want it to be auditable, export the tool to Excel, right? Take your summary tool, the summary page, export it to Excel, and then add a column there. Add a column where you show your math directly in Excel. And so you can print that, that off with the rest of the scenario in the tool to share with your auditors or examiners. So you have that audit trail, even though it's not on the interactive page.
And I would just add too, that's part of the reasons we also have the plus button at the bottom of the pools where you can, specifically show those balances for PPP or SBA or however additional pools you want. And so if you're capturing those and identifying those, you can leave yourself an audit trail of those additional pools as well.
Yeah, a couple different ways to skin that cat.
The next question is, do you believe the regulators have a number in mind that all banks should have as a reserve? 1 to 1.5% as an example. Officially,
There's two answers to that.
Yes, exactly. Exactly. If you ask an examiner that, they will typically tell you officially no. I think serving on a board at a community bank, I don't think there's any question that examiners have a level in mind. And I think it's not only a percentage of 1 to 1.5. Oftentimes, it's also median of your peer group. I know we are OCC regulated, and despite our loss experience, we always get feedback when our reserve falls below the peer level, the median peer level. So is that an official number in mind? No, but it's kind of like when you train somebody to react to something. We're trained to monitor when we get at or below that peer number. We know that that's going to prompt questions or inquiries from the regulators. So a number of regulators, have told us, again, early on in CECL, that banks looking to lower the reserve because of the methodology change and better experience, we're probably inviting scrutiny. So if it's, it may not be official, but you can certainly imagine you're going to invite scrutiny. Steve, anything you want to add there?
I think there's no difference to to answering that question right now than there would be 2 years ago. We're playing the same game with a different set of rules now with CECL, right? So they may look at your methodology and say, look, it looks like you're doing this exactly correctly. You've properly implemented an appropriate methodology for complying with CECL. Looks like your explanations and everything are excellent for your Q factors. It's good documentation. Now, hint, hint, wink, wink. Try to find a way to get it to end up not too far off from where you are today. That depends on what side of the bed your examiner woke up on, right? So we think that we're still dealing with humans here, and we still think that from a practical standpoint, it may end up not that different from what we're doing today, but they're certainly never gonna go on record as saying we expect it to be between X and Y, because that pigeonholes them, right? That puts them in a box that they can't get out of when conditions change.
The next question is, as banks adopt to this new routine, do you feel regulators will be, quote unquote, more forgiving in terms of adaptation until they feel comfortable? I don't think I would characterize it as forgiving, but I do believe they're going to be understanding, right? I think they have made that, I think, fairly clear. And I think, again, it's something why we've approached this as a process, right? As Steve mentioned earlier on, they're learning just like you are learning. This is an accounting standard. It's not a regulatory standard. They obviously have to comply with that accounting standard for regulatory purposes, but they're learning just like all the rest of us. So yes, I think they have been open in the sense that they're going to be understanding. They want to follow the process, understand the process. And again, I think they will be understanding as we work towards this. And then as time moves on, expectations could rise into the future. But right now, no, I think they're going to be very understanding. Steve, anything you want to add there?
Nope, I think that captures it.
Okay, the next question: for small banks of 250 million or less, can you make a recommendation as to what method is best? Well, I'm just going to sit here and say the CECLSolver from QwickAnalytics.
Go ahead, Sean.
I think we chose this methodology. One, it was, one of the methodologies, presented by regulators in their earlier talks in 2018 as an acceptable way. I would say anecdotally, it's probably the most common or popular selection among community banks, the warm methodology. So, I think it's got a familiar feel to what you're doing in the ALLL today and in the incurred loss. So I think for those and a number of other reasons, I think the warm and utilizing call report has been very popular. Steve, anything?
Yeah, I would say the warm method works really well with to be doing a lot of this at the portfolio level, as opposed to having to do the entire analysis completely at the individual loan level. The challenge there is most of the methodologies you see out there, what I call more complex methodologies, require a ton of really consistent, really accurate data on every loan going back an extended period of time. Something that most community banks have at least some sort of challenge with historically is gathering enough of that information. By the way, as a best practice, we do suggest that you start trying to gather any of that loan level information as you can, because as you grow and as we move forward over the next couple of years, more of it will be required and more of it will be helpful. But unless you, and even if you have that data, you still kind of end up living in a bit of an echo chamber, because those loan level analyses with all custom segmentation and custom risk pools don't allow you to see outside of your four walls very well. The way we use the WARM methodology, we do a lot of it at the portfolio level, and that gives us access not only to consistent call report data going back decades, it gives us access to everybody else's data on a perfectly apples to apples basis from a segmentation standpoint, which again, no matter how granular you're getting with your analysis, if you've got zero net charge-offs in your mortgage portfolio over the last 9 years, no methodology based on internal data is going to give you a justifiable CECL reserve other than zero. So you're going to have to find some good comparable external data that's apples to apples. And at the loan level, it doesn't exist. It exists at the call report level. And that's why we think that this methodology is so helpful, as long as it's flexible to manage any of your individual quirky situations, which we believe it is.
Great, thanks, Steve. The next one just looks more of a comment. Examiners don't have a number, but the call report limits your ALLL to 1.5% of risk-weighted assets. So
well, that's 1.25%. Only 1.25% of your ALLL will be counted towards your total risk-based capital, right? That's what you're referring to. Certainly true. So you get less benefit for having a larger reserve from a risk-based capital standpoint. I will point out that that's not super relevant for all the community banks that have elected CBLR, who are no longer calculating total risk-based, risk-weighted assets, and they're just focused on that leverage ratio. So the total capital and the risk-based, risk-weighted assets become a little bit less relevant for them. But your point still stands. It does have that effect.
Next question is, what kind of communication to our board is necessary or needs to be contained in board minutes as we decision what methodology we elect? Again, I think it's important to provide your board with the reasoning why you selected a methodology, to document that, as well as that'll serve as a blueprint for your examiners when they come in to see, how the decision was made. We have some suggestions within our tool on that presentation. So again, Steve, anything you want to add there?
Yeah, no, we have a little Word document template. It's kind of short and sweet, but it does explain what how our tool works, why it's appropriate, and how you're utilizing it. It's sort of to become from, it's a Word document that you kind of plug in some data, but it's coming from you, right, from your side. So it's a good thing to have in the. So we can certainly help with that process. But yeah, you're going to want to document not only all the assumptions you make after choosing a methodology, but what your initial choice of said methodology is and why you think it's appropriate.
Next question is this is new territory for many banks. Does it make more sense to have an external consultant involved to add more credibility to decision making? So, I was actually at the Indiana Mega Conference this week, and I kind of touched on this very question. Part of in any decision you make at the bank is what you want from a particular tool, right? So we speak throughout the country, and oftentimes I always laugh. If I was an auditor or an attorney, oftentimes, and I stood up and sold my expertise, it's not considered selling. If I do it through a solution like QwickAnalytics, then I'm considered a salesperson. Again, it's partially just how you feel or want to look at this process. The FDIC did a number of webinars, which we, again, document in our tool, that showed plainly and explicitly how banks could handle this on their own. So I don't think there's any credibility to be gained other than if the fact you feel like you're bored or you personally feel there's more to be gained. But no, I don't think it's necessary. Steve, anything you want to add there?
No, I'd agree with that.
Okay. Next question. We are currently adjusting our historical loss rate to match a peer group weighted average loss rate. The peer group we created is similar in size and location to us, roughly 50 banks. Do you think this is something most banks are doing? Yes, I do. Maybe not the additional custom peer group. I think it's a great idea personally, because again, I think those are banks that are swimming in the same swimming pool with you. And so it would make sense that to see any variances of how your portfolio's acting versus there, because you're literally living in the same or similar set of circumstances. So I think it's a wonderful idea. It's something I encourage most banks to do. Some do it, some don't. I think UBPR is always important because that's what your regulators look at. But I think for understanding your local market, which is what I think really should in some ways drive our Q factors, I think peer groups like this are outstanding. Steve, anything there?
Yeah, I suggest both if it's not too hard. Having a UBPR peer group just gives your examiner that warm, cozy feeling because they know exactly who's in it and why they're in it because they are the ones who design those peer groups. But building an intelligent local-based peer group, I think, gives you the absolute best, most defensible results possible. Especially when you're looking at historical losses at the segment level, right? Like I've mentioned a couple times, I think it's hugely important as a best practice to do that and utilize that peer data because just because your C&I loans got lucky, not got lucky, but didn't experience any losses. If you can look at all the C&I loans in your market, right, in your town, in your city, in your county, in your state, and then analyze the historical performance, no matter what bank they came from, it gives you a good feel for how that loan type performs in that market. And that's honestly what I think the examiners and auditors should be looking for when finding good justification for what losses to expect moving forward. And our tool, it's a good question. We thought the exact same way. That's why we built that kind of functionality as a centerpiece really in our tool. And it's very easy to build, to choose custom peer groups in our tool. You just you choose a geography, whether you want a state or 5 counties or whatever you want geographically, you choose an asset range, you choose any other specifications you want, and it builds a peer group in just a few seconds. And then you can run the tool using that custom peer group and then run it again using the UBPR peer group and compare side by side the differences. So your examiner can be comfortable with it.
Great, thanks, Steve. Next question is, I'm sure you already addressed this, but as we go into a rapidly rising rate environment, how does this pull into the CECL model in terms of stress testing on cash flow? So it doesn't necessarily per se impact it, other than what I would say is this. These are the types of things that, again, I think you can incorporate into your risk management process that is CECL's a part of, right? Doing stress testing at the portfolio level or the individual loan level might impact your Q factors. This is ultimately where I think the world of Q factors is going to go and why you want more loan level information, because you're going to want to understand your portfolio and its metrics better. And the way to do that is to have information over a long series where you can see changes or migrations happening or occurring within that. So it doesn't necessarily address directly into a portfolio solution, but I think can help, shape our Q factors. Steve, anything there you want to
add? No, not at this moment.
All right, thanks. And again,
by the way, we're running through it kind of quick because we had kind of some content here in case we had time to get it, but we're getting lots of really good questions, and so we'll keep answering the questions until the last possible second, and any that we haven't answered, we'll make sure we capture and try to get back to you on a one-off basis. Keep in mind that if you have a question we didn't get to and it's an anonymous question, we might not be able to get back to you. So you might need to shoot us an email or give us a buzz if we don't get to it. But I love to see the participation so far.
Yeah, likewise, and we'll certainly keep them for next time if we don't get to all of them.
Yeah.
Feel for how large core providers can be of help here, namely Jack Henry, CSI, Fiserv, CBS. So again, I think getting core exports, making sure, as we touched on earlier, warehousing your ILDR file, the interagency loan data request file. Some people call it the flat file, your loan tape or trial balance. I would make sure you are getting that data from your cores, and whether you're using it today, make sure you're warehousing it for the future. Because again, like in our IntelliCredit division and in the potential evolutions of where CECL goes, we think having that more loan level data available can be very helpful. And so while you might not need it today, if you don't save it today, you might not have it in the future. So I would encourage you to make sure you're warehousing that information. Steve, anything there?
Yeah. So if the question is how the core providers can be of help, what I would love to see from the core providers to help us in this would be if they can do, if they have readily available weighted average remaining maturity calculations that they can organize by call report segment. So if you can go onto your core and request a report that has, here are all my call report segments, and here are my weighted average remaining maturity, maybe without a prepayment assumption. And then also separately, some segment level prepayment studies, historical prepayment type studies, so that a bank would have access to what their contractual remaining average maturity is, and then what type of prepayments the bank has seen in that segment over different historical periods. It would be really helpful data from the courts to provide in the CECL process, whether you're using our methodology or any methodology. You can't really get away from, what's the average remaining life of my loan, since CECL is all about estimating losses over the remaining lives of the assets, right? And it's a big challenge for community banks around the country sometimes to get accurate data there. So it'd be lovely for the courts to step in and help more.
Great. Next question. I'm with Steve. I love all the questions. Even some of the ones like these are even better. When we think of peer data, what do you feel is the best source to pull such info to align with our own bank? So in our tool, Steve has built in our IT team has built a wonderful custom peer group creator where you can filter by, your UBPR, you can filter by state, local MSAs, asset size, different financial filters and metrics. So we have a wonderful tool to build a very personalized and appropriate custom peer group. Steve?
Yes. And in addition to kind of a filtered peer group where you say, like, everyone who matches these 5 filters, I want to be in my peer group. You can search for banks based upon literally anything. If you have a bit of a different business model, and it doesn't matter that you're in Northwest Indiana, it matters that you're very high on a specific type. You do a lot of leases, or you have a very specific loan type that you guys focus on. You can search for that metric throughout the country and handpick 15 or 20 banks that match that. So you can also go with like banks that are maybe outside your geographical market if it makes sense for you, and handpick the banks that you want based upon that to add to your peer group. So very easy to build that. You can build multiple peer groups, and then you just click a single button and the entire tool recalculates using that different peer group. So it only takes literally a couple seconds to see some different versions of CECL and stress testing and everything else using some different, through the lens of some different types of peer groups.
Great. Next question is, if we wish to use your model on a trial basis, can we do that without a fee? We're not trying to avoid cost. We want to make sure we have the right fit. Yes, we're happy to do and have done trial periods. So I would just say reach out to Ricky, Melissa, or Pam. Set that up. But we're happy to provide a short trial period so you can evaluate it and make sure it's appropriate. We have no problems with that.
Yeah, and you'd have full access to the tool, be able to see your data in there and really give it a full kicking of the tires.
The next question is, please share what your fees are for this model. Has it also had any review to validate its output, including from regulators? So again, multiple questions here. One, our fees are based on asset size. So again, we're happy to share that with you. Just reach out to one of our sales team. Regarding reviews, yes, we have a SOC 1 that's listed and available for you to pull down on the tool, as well as our credit stress test. And then we have discussed this and shared this with the FDIC and other regulators. We are in the midst of, we have training scheduled with FDIC, regional offices over the next couple of months. So we have been very forward approaching of them to make sure to see if they have any feedback. I would also add, we built it from guidance they provided. So we feel very comfortable and have had very good reactions from regulators. Steve, anything you want to share there?
Yeah, I mean, we've gone from top to bottom, from not only with FASB, but also with the FDIC and other banking regulators, shared the tool, walked through it in detail, gotten feedback, made changes, shared that with them. We're constantly, getting feedback from examiners on the ground with banks who are using our tool. There's, hundreds of banks that are currently using our tool right now. And we also have some auditing firms that utilize our tool and share it with all their customers. So we spent a lot of time with the accountants making sure that this is appropriate and gonna pass muster as well. And certainly the SOC audit, is very comprehensive in following the tool through from A to Z to make sure it does what it says and it does it accurately.
Next question is, what's an appropriate way to determine basis point ranges for each Q factor? For example, if our experience and abilities of lending management and staff goes from stable to moderately lower, how do we justify this being a 40 BIP adjustment versus a 20 BIP adjustment, et cetera? So again, again, this is where that subjective nature is. I don't know that there's one objective way to do that. I've seen a number of banks have ranges, preset ranges, and depending on whether they move that stable to moderately lower, they've already got predefined levels where they will move those depending on those assessments. Again, I think this partially has to do with your own loss experience, right? If you have a very low loss experience, changes like this might need to be higher because you're still trying to defend a reserve. This is where, again, I think, you can kind of get into a rabbit hole. I think the place to start for most banks, in my opinion, and again, this is just my opinion, is you and your board have an idea of where you want the reserve to be, right? Reserves are designed to cover expected losses. Capital is there for unexpected losses. So your board, I'm sure, has a philosophy on where they would like to see the reserve, and you or your management team does. This is something that you've developed over years and built a comfort with your board, regulators, and auditors. How you've kind of defended that over time, I don't think ultimately drastically changes with CECL. We're just changing the objective piece of that. Steve, anything you want to add?
Nope.
Okay. All right. Just a few more. Then I know, Manisha, I think I'm pronouncing your name right. I saw you raised your hand, so I'll try to get to that.
We've only got a couple minutes left, so we need to
wrap up. Okay. What can you provide us for our vendor management perspective that will include the validation aspect? Yeah. So we have an entire due diligence package you can request from our team. And we think we have everything addressed. Debbie Walker, who heads up our regulatory area. Debbie's our most senior employee. She's put together a package, for all the necessary things. So, I think it contains everything you'd be looking for. Steve, anything there?
Nope.
Okay. Is there a one-time fee from you for setup, and does that include specific tailoring to meet our needs? There is a one-time fee if we're going to calculate your warms. I'm not sure specifically about tailoring your needs. I think what we try to do is be there as much as you need to make sure the tool is doing what it needs to do for you, and you have a comfort level in operating and utilizing the tool. So again, I think this is a reason why it's worthwhile to begin running parallel, so you can go through that process. Every bank's a little bit different on how many times you need to do it, but we're going to try to assist you as best we can. But we feel like our tool is going to be fairly familiar to you and won't take long for you to get comfortable.
Yeah. I would say that there's, we have, it's a subscription basis, and it's an all-in type fee. So if you need some additional help from us, if you need some time going through it with us, we'll give you that time. We'll walk you through the tool. If you want to go through it once you've calculated your warms and talk about any specific situations, all that is included in our one-time fee. We don't have any nickel and dimey type stuff. No setup charge. The second that we turn on the switch, you can do everything that I showed you today on the tool. The only time we'd ever charge any extra is if you want us to calculate the entire warm for you on an ongoing basis from your loan level data. But outside of that, no additional fees, no setup time, no setup charge, none of that.
Do you have any suggestions on how to determine the estimated probability of funding for commitments?
We didn't get to that. That was something
Yeah.
I had some slides for. Actually, we'll make sure that you all get a copy of this presentation, even though we only got like 3 pages into it. Today, I have a couple slides specifically that discusses the unfunded commitment, where we come up with those estimated probability of fundings, which is we have some good default values there, and there's some reasoning behind it. It's explained in the footnotes of our tool, but it's also in this presentation. So make sure you take a look at like pages 12 through 15 or something when you get this, because we detail exactly where that comes from. Good question.
Yeah, it is a good question. And there's a good chance we're going to cover some of this again next month, since Steve said we didn't really get through, but the questions are fantastic.
Yeah.
How many banks have elected to use your model? Can you share references, and what size of banks have been most common to you? Again, multiple questions. We got over 250 banks who are using, CECLSolver. So
yep.
We of course can share references. And so again, something you can request from our sales team. And, size of banks, we're all the way from, 50 million to over 2 or 3 billion. So again, I think it's, it covers the normal range and size for community banks. Steve, anything there additional to add?
Nope, that's it.
Okay. Hi, Sean. I'm going to take a guess and say that's Steve Pokrack. Steve, how are you?
That was anonymous. It could have been from everybody,
Yeah,
from
it could have
anybody,
been, but I'm
Sean.
going to guess it's my friend Steve Pokrack. What are your long-term plans to accommodate changes on the horizon, meaning from the economy or regulators? So again, as I mentioned, our tool is evolving, right? We're going to continue to take feedback not only from you, our users, but from auditors, regulators who we talk to. I would also say this is where our IntelliCredit division is standing by ready. And that's why I always say, collect that warehouse that loan level data. We are building additional solutions for when and if it's necessary for our banks. Our position today, though, is it's not necessary. So there's no need to necessarily do it, but you should be writing that insurance policy of capturing and warehousing that loan level data. But whether it's PDs and LGDs in the future, other methodologies, vintage, you name it, we have additional tools. We just don't think, given the environment today, most banks are going to get any benefit from the extra time, effort, and money that it's going to cost. Steve, anything?
Yeah, but as far as enhancements to the tool you saw today, the portfolio level, CECLSolver, we're going to be adding a tab for the held to maturity securities, which we can talk about with you. We're going to be adding an additional enhancement to the Q factors tab, which gives you a little bit more granularity in the Q factors. And we're going to be adding some more stuff you can work with from an econometric standpoint. Those are 3 things that we will be adding as we go along this year that are already kind of in development, and certainly other ones as we see the need.
Well, we got to cut it here today. As Steve said, we didn't get through the slide. This was an outstanding session. Thank you all very much for the questions. We will be on again next month. I'm just going to go through this. We will send this slide deck and the recording, so you do have it, but chances are we will cover these again next month, June 10th, where we will have a guest panelist. Another auditing firm is going to join us. Josh Bowen from Warren Averett is going to join us. And so we look forward to that. So we encourage you to continue to attend. As Steve said, we've got a number of developments and enhancements in the works, more to come. Again, a lot of it coming from you and suggestions you make. So continue to share any thoughts. Look for the email from us with a link to today's recording and the presentation. And please join us again next month, or even later this month, if you want a more in-depth presentation on the CECLSolver. Steve and I will do that on May 24th, and then we'll all be back on June 10th for the next edition of Coffee Talk. So on behalf of Steve, thank you so much for attending. Thank you for the great participation. I hope you found it helpful, and we'll look forward to seeing you and talking to you again next month. Have a great weekend.
Thanks, everybody.
Thank you.